there's a rule when it comes to real estate investing, and it's basically for every 1% of mortgage rate, you lose about 10% in purchasing power, 10% of home value in the real estate market. And here's why: because nobody buys a home, or very few people, a small percentage of people buy homes cash, and those who can afford to pay cash shouldn't pay cash, in my opinion, but that's another video. 30-year mortgage, fixed, 3.99%. So your payment there is $3,815. So what happens is that's what your house is worth, is that $3,815. It is not worth $800,000 because that's not what people, are paying. They're paying it out of cash flow. That's how the real estate market works. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to be talking to you about Zillow and how they just changed their forecast for home price appreciation in 2022. And this opinion, this shift from Zillow just shows how crazy the markets are right now, how fast things are changing, and ultimately how on your toes you need to stay. You cannot get lazy when it comes to your financial strategies right now. So let's get into this. All right, so here I am. I got, I'm gonna zoom this in a little bit here. But bottom line is, there's this article that came out on Fortune. I have to share it because I saw it, and it's pretty crazy. So you can see here, heading into 2022, there was a wide consensus among real estate firms that the annual rate of home growth, which peaked at 20% in August of 2021, would steadily decelerate this year, right? So a lot of people were thinking that was the case. Now, back in December, Zillow forecasted that the 12-month rate of home price growth would decelerate to 11%. So if it was at 20, it was going to go down to 11 this year. But then in January, it upped it for 2022 to 16.4%. They thought it would grow. And then in February now, they've increased it to 21.6%, right? Which is kind of crazy when you think about what's happening. Now, the reason they say that is because even if interest rates start to rise, their perspective is that the facts are that supply and inventory are extremely low right now. So you can see here that the lack of inventory means that buyers will once again be forced to bid up prices on homes. It's crazy right now. I live in Arizona. I'm not sure where everybody obviously watching these videos in different places, but I know all over the country, there are bidding wars on these houses. Right now, it's not uncommon for, houses that are listed for $800,000 in Arizona to get 20 plus bids on them and to go for $100,000 to $150,000 over asking price, which is crazy because there's no way a house, when it does that, is going to meet appraisal. So what that means is these people have to come in with more capital. Now, I know a lot of that's happening here because people are coming in from California, but these are all things to kind of take into consideration. So if the year over year rate of home growth does hit the 21.6% in May, like they said, it would mark the single highest data since the data was first collected in the 1980s, right? It's 5 times greater than the average annual rate, which is 4.2%, and it's well above the 12-month price jump of 14.4% recorded in the years leading up to 2008. So think about that. Back then in 2008, when houses were going up fast and they were unsustainable, 14.4% was the growth that houses were growing at. And now look at what's happening in the economy right now. So then here's the thing. You look on the flip side of this though, and CoreLogic and Fannie Mae both think that home prices are gonna climb at much smaller rates. So CoreLogic thinks 3.5% growth, which is a big difference from obviously where Zillow is, and Fannie Mae expects 7.6% this year as a whole. And so when you look at the widespread difference, it just goes to show that it's a big guessing game right now, right? Like that's a scary place to be. Markets hate uncertainty. Stock markets specifically hate uncertainty. Real estate markets are a little bit different right now because we have such low inventory issues and we have inflation on new builds. And so, my wife and I are looking at buying this condo Airbnb, this condo hotel Airbnb in Orlando. And as we're looking this over, one of the things that they're looking at developing a second section of this condo hotel, right? And it's all managed for you and all this stuff. And so when they go to develop the second building, while the units that we're looking at are about $300,000, all the units that get built in the next development are going to be about $350,000, because when they break ground, the cost of lumber and all the materials right now have gone through the roof. So just that alone is going to drive the prices up in all the comps and all the in all the area, right? Because as they do that, that's just the nature of the beast, and that is one of the things that's leading to the real estate inflation as well. So when you talk about the fact that, there's all this kind of nonsensical bidding up because people just want to get into these homes, and, they're probably spending more money than they should because they cashed out of their homes and sold homes in places like California for more than they should have. So they're just sitting on this money, and, rather than being patient or moving somewhere where it's not as competitive, they're coming to places like Arizona and Texas and Florida, where they actually have freedom, and that's a good thing. But they're looking to do those things and take advantage of the markets. But the bottom line is, when you look at just the wide gap in projections for what's going to be happening for 2022, and you have Zillow at over 20%, and you have CoreLogic at 3.5% right here, right? We're talking about a 17% swing effectively, right? Like from where these professional, companies are projecting real estate values to be. And what I am looking at is, if you look at the 30-year average here, or the 30-year mortgage, mortgage rates are up to 4%-ish right now, right? Actually, you know what I'm going to do is I'm going to go to Google. Mortgage rates today. Let's just take a look at this and see what they are. So actually, the 30-year fixed rate right now is bumped up to 4.442 on Google, right? Which is a really big jump, right? So this is one of the things that they're talking about. Let's see if you get a better credit score. Yeah, 4.2. It still doesn't go up even when your credit score gets really good. The rates have increased significantly, and the reason they've increased significantly is because they're concerned. So here's something to consider, and I want to do this really quick. I'm gonna show you the mortgage calculator. I think it's really important to understand this, right? Because there's a rule when it comes to real estate investing, and it's basically for every 1% of mortgage rate, you lose about 10% in purchasing power, 10% of home value in the real estate market. And here's why: because nobody buys a home, or very few people, a small percentage of people buy homes cash, and those who can afford to pay cash shouldn't pay cash, in my opinion, but that's another video. So let's just say you have a house that's $800,000, right? And so let's say you did a 30-year mortgage, fixed 3.99%. So your payment there is $3,815. So what happens is, that's what your house is worth, is that $3,815. It is not worth $800,000, because that's not what people, are paying. They're paying it out of cash flow. That's how the real estate market works. So if let's just call this 4%, just for the sake of me being able to talk around numbers, right? So 38.19, right? So now if interest rates go up to 5%, that's 42.95. So let me go back to 4%, 38.19. So check this out. Now I'm going to go to 5%. Now I'm going to try to get this payment down to 38.19. So you see here, I'm going to go to 720,000. 38.65. So it's still higher, and that would be about 10%, because 80,000 off of 800 is 10%. So this is actually just showing. So let's go to 700,000. Okay, so it's somewhere in the middle. So 710. Yeah, so that's pretty close. 710,000 and change. So that house, if rates go from 4% to 8% or to 5%, that house that people can afford to pay is $3,815. That housing value, those people are still assuming that the economy is sustaining and jobs are staying the same, and because incomes are not keeping up with inflation right now. So it goes to stand that their cash flow is going to remain pretty level. And so what's going to happen is housing prices are going to come down to meet what they can afford monthly. That's just the way the market works, right? And so it goes to show here, and this is what I'm talking about right now. This is why a lot of people are concerned if the Federal Reserve raises interest rates and they do their 1.5% rate hike, that's going to raise the 10-year Treasury bond, the Treasury note. And so that's typically what mortgage rates are tied to, is the 10-year T-notes. And so like what's going to happen is the interest rates are going to go up to probably 5.5% if that happens. And you can see here that if 5.5% goes, like, well, we got to get that to 38.15 again, right? So 650, 675. Yeah, we'll say 670. Sure, close enough. So it's 670. So that $800,000 house in today's environment goes down to $670,000 in that environment where interest rates go up. So that's just something to kind of take into consideration. So I hope that helped give some clarity on what's going on. I think it's crazy, the idea of 22% growth for houses, or 21 and change growth in the real estate market this year, especially coming off the biggest year that we've had in history. And so when you go back-to-back years like that, that just tells me that we're at the end of a cycle that's not sustainable, and that it is a bubble. Like, these things don't grow this fast in a well-principled nature, right? Like, this is outside of the realm of normalcy, and these things always end in a bubble that ends in it popping. And so the question is, how much juice can you squeeze out of this for yourself personally before it pops, right? Before everything just kind of corrects. And can you take advantage of that in the process? And how do you position yourself to take advantage of the upside, protect yourself from the downside? Because I'm a big believer, you got to look at it from the what's the upside, what's the downside, can I live with the downside? And you got to take that into the equation for yourself. So if you have any questions at all, leave a comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you get notified every time I launch a new video. I'm going to be following these trends, inflation, the real estate market, talking about cash flow investing, all this stuff very, very diligently in the next 6 months to 8 months as we come up to the election here, because I'm telling you, this year is gonna be a wild ride, so strap in. So anyway, I hope you found value in that. As always, have a blessed, inspirational day, and we'll talk to you soon. See ya.